Hello, folks. Brandon Chapman with you today. It's another edition of the TheoTrade video for Monday, November 21st, 2022. Let's take a quick look at the market today. We got some, we're talking about the bulls looking to give thanks, but the US dollar may run off with the turkey. So where is the market going to head? We had a great week off of the CPI data, big move on the 10th. We're presently consolidating. Look like we might have a chance to see a little bit of a bounce here, but that today kind of faded with news out of China. Obviously, some COVID deaths. That's terrible to hear, but the restrictions may start to heat up again. So some of the optimism in the Chinese space may be waning a bit. You can look at FXI, for example. It was down a little bit today. So the market's kind of sitting back wondering, what is the next leg going to be? And this time of year is obviously traditionally pretty bullish. There's, of course, the Santa Claus rally that occurs the week between Christmas and New Year's, which a lot of media is extended to be the entire month of December or after Black Friday, which isn't exactly the case, but it's very reasonable to see this might just be a short consolidation en route to a bigger move. The question is, do we consolidate a bit more, maybe get a rally the last week or two to 42, maybe 4,300? Do we pull back here a little bit, retest 3,700, and then rebuild again towards 4,000 and 4,000, 40.50 being the top for the year as we kind of close things out, which stands about this 61% retracement of the decline from August through September? Again, do we just sell off and stay down? When you look at the VIX as an example here, VIX, the VIX did sell today. So the more this can push towards 20, it probably is going to mean more limited upside in the near term here, setting up for maybe a late year sell-off. As I look at the VIX 300 VIX ratio, this yellow line, this kind of gives you a sense of what the market's expecting in terms of future volatility. The value today is 1.1. What that means is the 3-month VIX is about 10% higher than the VIX, meaning that the sell-off in the VIX today, this VIX selling, has led to a little bit of steepening here. We want to see this get north of 1.2. There we go. To really kind of give that bearish type signal like we got in August as an example. So still some work to do to the upside. So at least for right now, on a short week with Thanksgiving coming up on Thursday and a market closure, only half day on Friday, we may have a chance to maybe just bleed higher here. And I'm really interested to see what happens to the VIX, whether we see continued selling the VIX that may help reset those downside late year expectations. You look at the VVIX today, this is the volatility. Down, right? So down on Friday, flat today. Do we remain low down here at 80? And again, if we can still remain low, we see back month volatility build relative to front month volatility, pushing to 1.2. And then we see skew start to pick up, which we don't have a value for today, but we're about 115 right now, which doesn't really indicate a lot of downside potential. We got to see with the VIX selling, we got to see this start to push up. Maybe we don't get that by the end of the year. And that's the bullish case where maybe we hang out and rally a little bit towards the end of the year. The point being is there's not a lot that's really bullish right now. The best thing that the bulls have going for them with regards to the S&P or the Nasdaq or what have you, it all comes down to one thing. And that is, of course, the US dollar. You can use proxies like the UUP, which UUP is an ETF that tracks the dollar index. We have approximately a 57% weighting to the euro/US dollar or the inverse of that. So this is going to move with the euro, whichever direction it may go. But the idea is that we see the dollar today strengthening nearly 1%. And notice the S&P is down 1/3%. When you understand that a rising dollar puts bearish pressure on the S&P, and all things being equal, if we look at gold, in real terms, gold's down 0.5%. We look at this and say, the market's up a little bit because gold's down 0.5%. The dollar index is down 0.9%. This is only down 0.36%. So in reality, the S&P has the mirage of being down today. But if you eliminate today's weakness in the dollar, it may actually be higher And then that helps kind of explain why the VIX is down while the S&P is down at the exact same time, which is kind of unusual. But about a third of the time that happens. So what we're looking here is, where's the next leg going to come? The dollar is going to have a tremendous amount of say in that. And we've gone from a previously very bullish orientation and positioning to more bearish positioning right now, which can lead to a squeeze that may push the dollar higher. And that may spoil the party for the bulls to looking for a big move in the S&P to end the year. We may have seen a lot of the low-hanging fruit in the rally already take place, and a stronger dollar will keep at bay any sort of significant rise. Because as we know, most of this rally occurred because of the weakness of the dollar, not despite it, okay? That's helped benefit it. As we look at the 3-week returns here, the various indexes, we got the XLB, XLI, XLF. Again, you'll notice here kind of a more bearish orientation with staples and utilities kind of in the middle of the pack, while cyclicals, energy, communications, and technology are really bringing up the bottom over the last 3 weeks. And if you look at the last 6 weeks, it's industrials, financials, materials, staples, energies in there as well, but cyclicals, communications, technology, some of the worst performers, of course, cyclicals being the worst performer and near lows from May. Let's go back to the S&P. You'll see that we're off the lows we're about those, man, from the lows in June. So what you're seeing right now is not exactly the most bullish orientation. And today, on a down day, maybe predictably, staples are actually higher on the session, about 1%. You've got utilities in the mix as well. And I'm thinking utilities may have a chance of rolling to 72. That's been my target since back here, since we kind of found the bounce. We've had some bullish activity in utilities as well, looking for utilities to lead out. This may be another week where utilities lead and may create more questions for the market than bullish answers going forward. As we look at the top, S&P 100 here, let's get to the right one. The best performing stock today was Disney. Now, Disney's interesting. So they get rid of Chapek, they bring back Iger, who left, I believe, in 2020. Interestingly enough, the issues with regards to Disney's earnings, and I know those are out there that are on the political side, partisan side. Oh yeah, they're getting what's the realities are they're not monetizing the direct to consumer model that Iger created. And now he's back and the market's suddenly up 6%. The model that he created, right, developed, is the exact model that's causing Disney to lose money, right? $1.47 billion lost last quarter, double from the same quarter a year ago. Theme park falls short of estimates as well. So what we're seeing right now is this kind of vertical integration of producing content, distributing content, and hoping that content drives them to your theme parks. The problem is, are you going to continue to be a loss leader? Maybe not a loss leader, but are you going to continue to lose on the content and hope you can make it up with a better experience in the parks? That's the vertical integration that historically has never worked. They've really been, in the past, very guarded on the content they're releasing. Movies going into the vault, then being re-released to generate interest again in the theme parks. And so we'll see whether or not the model of direct to consumer really works. And are they bringing back somebody that's really prepared to put them in a position to be more profitable? Or are you putting somebody that maybe is more politically viable, trying to balance both sides of this thing? But in reality, the model itself is the thing that's not working. If you look at Disney's estimates, they're continuing to see sharp revisions post earnings. And as a result, the outlook for Disney is not great. All we have is a temporary Band-Aid, and hopefully have someone that can message better than the outgoing CEO in this case for Disney. So expect to probably see continued downside here in Disney. Again, we might get some short-term lift, but you'll see the gap and then the selling today, not exactly providing a tremendously bullish footing, a la what we had, for example, in August following their earnings as well. As we kind of, look at there's a number of companies announcing this week in the technology space. Dell, oops, wrong one. Dell, there we go. No, we don't. Dell, as an example, has earnings coming up this week. Hewlett Packard announces this week. Zoom announces as well. And Best Buy. What we saw in 2020 was very unique. We had policy driving consumption very, very directly, right? To go virtual, to go online, to use more data, to use more energy, to use more equipment, right? So we had this huge push to basically leave the public square, right? To nobody outside your homes, be inside your homes, consume more, get on technology more, etc. And this was a boost to many companies in 2020. I mean, obviously Best Buy took it on the nose initially, but the policies helped really help Best Buy throughout that period. They adapted to the having stores and doing the white glove treatment and stuff like that. You can look at Apple, for example, and the tremendous boost that they got from those COVID related policies. Again, the biggest company in the world made out tremendously. Walmart as well. A lot of these big names did really, really well. But now all of a sudden we're seeing the consumer is getting tired. Macy's, as an example, in their earnings report suggested that there was softness in the sales in October into the first week in November. There's maybe a week in there where they saw a little bit of a tick up. The comment they made was, maybe this is more of a traditional holiday season. Well, let's see. We've got Black Friday coming up this week. Are we going to see the traditional kind of boost in consumption coming up this week? Because so far, what we saw from both Target as well, we did not see the boost, right? As a result, Target cut the outlook. Walmart got a jump because we saw people with Gucci bags, right? The non-traditional Walmart consumers shopping at Walmart, trading down for lower cost goods, lower cost meals versus your Chipotle's, etc. So what we are seeing right now is a trading down effect. And so again, are we going to see the traditional boost? We're going to get some outlook this week from AEO, so American Eagle Outfitters. They announce before the market tomorrow. So by the time you catch this, not much you can do about it. But there was some, I talked about in my session today, but there was some put activity for this week to the downside here at the $12 strike price. The expected move is $1.40. So you're looking at what, $11.60? The interest here is at $12. And so what are we seeing here? Again, we're looking for a downside bias. And again, it's been a very mixed bag. I mean, you've had stocks like Ross Stores, for example, a discounter, experience a big jump, right? TJ Maxx, a big one. Ross Stores is one we looked at last week as a potential bullish opportunity. Kohl's is one I looked at last week during one of our sessions or at the close for our clients. Blake and I hashed this out as maybe a double calendar candidate because we did have the drop before the earnings. But again, now we've got American Eagle. We've got CROX. I guess CROX is an earnings announcement, but we have a company that is a retailer. We've made a very big move post earnings. Notice today that is rolling over. Again, are we going to get the consumer to show up this week for Black Friday? Or does the US dollar strength and overall consumer weakness steal the show, steal the turkey, like Bumpus's dogs, right? In Christmas Story. As we go back to the trade tab here for CROX. This was a December downside put activity at the 85 strike here. Again, do we experience more downside here? So let's look at the option time and sales, and you'll see an 85 and 75 in here as a spread. So again, are we looking at downside here to 75? 75 gets you back to about right towards these highs again. This might be a pretty decent near-term expectation to approach this kind of 80 to 75 to 65 range back into that volatility box we had back here, for example. Newell Brands, we're talking Crock-Pot, we're talking Mr. Coffee, et cetera. Big downside move post earnings, right? This has not been a winner across the board. You've got your TJXs, you've got your Ross Stores, and then you got your Newell Brands. We're presently kind of forming a symmetrical triangle. at the moment of lower highs and higher lows effectively. We're just kind of winnowing in here, and we're trying to figure out which direction does it break. Normally, when you get that kind of move, you expect that trend to continue to the downside. The 161 target here is about $10. Well, today in Newell, you had if you look at the trade tab here, the December expiration again, 4,100 contracts, the 13 mostly bought, looking for some downside expectation or breakout, more at the money. Start to take out 13, we may be able to drive the price down in this $10 to $11 range based on the target here, okay? So again, downside expectation there. It's not all bad, right? We think about the turkey itself or foods. This is more of a staple. You'll notice we broke out big. This is US Food Holding Corp. If you don't know what this company does, for example, marketing distribution, fresh, frozen, and dry food, non-food products, food service. Again, so you can kind of see they're providing food. As we look at this, we had a nice breakout here. We're pulling back. We're testing prior highs, old resistance. Now we're above it as new support, and we're catching a bid the last couple of days. Gap down this morning, then rallied. Volume surge to be above average. If we take this little first run, pullback, and then we're kind of in this latter stage of this rally, but notice something here, right? We broke this 261, we retested it. We're looking at or eyeing $38 here over the coming weeks. And as we look at the trade that was put on today, this is a December expiration, more at the money at 35, but this may help create a little bit of fuel for a move or continuation, since this is the highest close we've seen since May 10th of last year, May 10th of this year. We may have a shot of retesting 38 in the near term. Volatility wise, 25 days out, again, $38. There's not, there's not a way to really construct, gracefully a spread in here, but it could be a stock trade just looking for about a 10% move or a little bit less here in the near term, with the exit coming at around 33.50. Tesla today. Obviously, if you've been following Twitter at all, it's getting fun again. But it is a little bit of Wild West. If you see, Elon Musk out there, I'm not sure he's gaining favor with a lot of investors per se, right? So as we look at this kind of downdraft here, consolidation, higher high equal, kind of lower lows, this consolidation here, breaking down again, measuring their retracement, but we could take this as a slight uptrend here, take this as the measured move, looking at 161 to the downside, it's about 138. And today in Tesla, we saw just a continuation of the bearish trade we've had over the last, struggling with the mouse. Continuation of this kind of bearish activity, the 11th right here, for example, later on the 16th. This is one we reviewed in our at the close session after the close last Wednesday. But today you're seeing a continuation in that bearish trade and outlook in Tesla. This one's a weekly in here. You see all the options of trading that's going on at the moment. This one's moved in the money a little bit, 175. We got 170. Again, just looking at more downside. The near-term target's going to be 140 to 150 in here. So it's a rather small pullback or retracement of the downtrend. 137 to 140 seems pretty reasonable as a near-term target over the next couple of weeks. You might get the retest here and then maybe a lower high and then a pullback again. You can kind of decide how you like to play this, but Tesla certainly seems to be angling the downside regardless of what the bigger picture is doing. Bonds, the bond yields today, 10-year treasuries were up slightly. Is the Fed going to raise rates as much as they expected? Probably not, but that's kind of the bet, that they don't get as high as was previously thought like a few weeks ago. But here's the deal though. It doesn't mean that the perception of risk can't widen out, and a stronger dollar will help precipitate that. We got a nice bounce in HYG. We're currently testing prior highs. It certainly looks like we might be in a mode to retest our lows. Now, a trigger, you might want to see it take out the low at 11.17 at about 73.72, and then eye down here about the 72 to 71 mark. as a near-term target for HYG. Coupled with some trade today, looking at the December expiration for HYG. Very, very busy type option here, but 73, 16,000 contracts, 70 and a half down here at 15,000. So looks like we're probably taking this and closing it out and rolling it down. So this is greater than that. So again, volume greater but interesting means it's new activity. We may be looking for this to retest, go down to 70 and a half. And so a little profit taking at 73 or extending it to the downside. 70 and a half gets you back to the bottom of the diamond formation that occurred on October 13th. And again, looking as a trigger being the low from the 17th, eyeing 70 and a half in the near term. That's HYG. Home Depot, think about consumers. Are they going to continue to invest in their homes if home prices are falling? All of a sudden your neighbor can't sell. Are you going to refinance with high rates? Where's the money going to come from for HD? Type in HD and CMG comes up. Anyway, where's the money going to come for Home Depot and consumers? And again, we've got Black Friday coming up. We're going to get some anecdotal data being released over the weekend, early next week, about how strong or not strong consumers are. We did see a strong earnings, a nice bounce here in the price. We kind of gap lower, and then we rallied throughout the day. But again, just looks like we're kind of extended here at 318 to 320. And it certainly looks like we may find a reasonable opportunity to trade back to lows again. Back to lows, pardon the pun, of 266. What you may want to see is a bit of a reversal here, breaking 310 to kind of precipitate the deluge of selling, going back to 270. But coupled with this is a Jan expiration. And this is kind of an interesting trade because it's probably something that's pretty viable. We're buying the 31% implied volatility at 290. We're selling the 35% implied volatility at 265. It is a $25 spread. It's costing you about 250. Again, buying the net 290, selling the 265 today. This provides, again, a nice, pretty cheap spread for that wide, 290, 265. And if we can retest prior lows, that's a very significant reward to risk. And you've got to January's expiration for that move to happen. And so I thought that was an interesting trade that's pretty reasonable here. A little bit speculative because it's out of the money. Your probabilities are relatively low, but $25 spread costs you about 250. It's about a 10 to 1, close to a 10 to 1 trade there. So if you're looking to add some bearish interest, that's one place to look, along with home builders generally. Mortgage REITs took it down and we're kind of bouncing back today. And you could also throw an XHB that includes Home Depot and builders as well. We'll wrap things up here with SLV and energy. So we'll kind of go commodity related. Stronger dollar should pressure commodities. The trade in silver today was a Jan 1750. So if you look in here, 1750 there. So as we look at the chart, 1750 gets you back to lows, which if a lot of the run here is because of dollar weakness, dollar strength may carry it back down here. So again, I thought that was an interesting trade, pressuring commodities like silver and gold. And again, downside verticals work because of the rising volatility to move out of the money here. Finally, XLE. News, OPEC's going to raise production to accommodate for Russia sanctions. Saudi Arabia reversed that. So no, we're not going to cut. The reality is, if the outlook for oil is weakening, they're probably going to cheat. But for right now, again, a lot of the policies are keeping the energy markets very tight, but we are seeing some weakening going on right now. Notice this red line, how it's flattened compared to maybe a week or a month ago or 2 months ago in there with the various curves on September 26th and October 3rd. We've definitely seen some flattening. We're expanding the potential weakness, right, in demand for oil, the kind of supply and demand scenario. But, are we a little bit oversold here in the near term? Yeah, there was a bullish trade. I'm not super excited about it, but I guess if you're looking near term to about 93, 94, this may work. but it was a 25. So for this week, looking for a short-term kind of move here at the 90 strike. So not really out of the money. There's a little bit kind of filtering throughout the money here, but again, there's a chance we get a little bit of a near-term rally back to highs. And but anyway, all right. Well, folks, we got to wrap it up there. We'll catch you back next Monday. But again, hopefully we'll see what kind of plays out today, this week for the market. From my perspective, I'd like to see us kind of push. I want to see the VIX see some VIX selling come in and see the skew rise to help set up more of like a bearish scenario to capitalize to the downside, because we know the market's going to get there. It's just a matter of when. Anyway, have a great one. Thank you.